Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello, and welcome to the Stock Play of the Day. Today's stock is the XLF. That is an ETF that tracks the financial sector. Today we'll discuss, should we pass or should we play? Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest.
And I'm Lindsay Bell, Chief Investment Strategist at Ally Invest.
Well, Lindsay, I got a chart of the S&P 500 index up here. It's a daily chart, and I'm seeing a lot of green candles over the last few days. What do we see going in this week on the markets?
Yeah, the last few days have felt a lot better than what we felt like in the beginning of or at the end of September, I think. But anyway, last week we had a really great week, and today we're seeing a follow through of that. Last week the S&P 500 was up 3.9%. It's the best performance the index has had since early July, and it was really a broad-based rally, which was very nice to see. I think what was driving the market last week and what continues to drive the market today is all eyes being on what's happening in Washington with regards to potential stimulus. I think investors are really starting to price in us getting some sort of form of stimulus either by year end or at the very beginning of Q1. And the good news is I think the economic data that we have seen has sort of stabilized. So it's maybe not moving as significantly higher as it had been in the prior months. But it is stable, and there is enough stimulus in the form of monetary and fiscal stimulus that is already in the system that I think is going to allow both consumers and corporations to be able to have the wherewithal to survive the next couple months without any additional stimulus. But they may not have much longer than that. So we do need that stimulus, and like I said, the market is kind of pricing it in. I also think last week, towards the end of the week, it was interesting, Brian. You and I talk about the VIX all the time. On Tuesday, we saw the VIX pop up to 29, but it ended the week, I think, around 24 or 25. We're up a tad bit today, but still in that 24, 25 range. And I think what really drove that is there's this perceived expectation of a little more election clarity than we had in the past as Joe Biden's lead over Trump had expanded over the course of the last week after the last debate. So it made investors feel a little more comfortable about what the outcome could be. And also the expectation that all of a sudden a Democratic sweep could mean a lot more stimulus for the economy. So that's kind of how investors are really looking at it. I'm not necessarily of the camp that we can take a breath of relief at this point in time about the election. I think there still is risk. You and I talk about VIX all the time, but those are going to continue to be key drivers over the coming days and weeks. But this week in particular, Brian, what's awesome is that we're kicking off third quarter earnings season. Now, the numbers are expected to be pretty weak, a decline for the S&P 500 of 22.8% in growth. That's very weak. We have to go back to 2009 to see that type of decline in earnings on a year over year basis. But the good news is there is a silver lining is that that number has improved over the course of the last couple of months. So since mid-July, when second quarter numbers came out and they were much better than expected, third quarter numbers started to improve. And it doesn't necessarily mean that the bar has been set higher going into this reporting period. When there's this much uncertainty, very few companies reporting guidance or forward-looking expectations. Analysts that come up with the estimates are kind of left in the dark. But the reality is that the economic environment has been improving. So that's why the numbers are going higher. And we have seen in the past when this phenomenon happens, last time it was in 2018 and 2011, when the new tax bill was passed in 2018 and in 2011. We were coming out of the financial crisis still. And when the numbers move higher, analysts usually are guessing correctly in this type of scenario when there's this much uncertainty. So we're optimistic that things are going to turn better. We're going to talk about earnings for the financial sector here in a bit, but that's the setup. JP Morgan unofficially kicks things off tomorrow morning with their earnings results, and a slew of other companies follow them. So there's a lot of big news happening in the coming weeks that will certainly have an impact on the market. But when I look at this chart of the S&P 500, it really has in the last couple weeks has had a nice run higher. And Brian, you and I had been talking about the 50-day moving average, which I think is your red line there, and we're steadily staying above that. What do you make of the technical perspective of what's happening in the market?
All right, Lindsay. Yes. The last couple of weeks, we talked a little bit about this head and shoulder pattern that was happening, and it was forming in all the major indexes. We could actually see it in the NASDAQ. On the open, the NASDAQ hadn't quite broken out of it to the upside. We see in the S&P 500 index that, yeah, that has happened. If I draw the neckline here just with my little cursor, and I'll try to stay away from that moving average, we see that that was basically the neckline of the head and shoulder pattern. And we have 3 green candles above it. So it's definitely broken out. And then there's also something to note that I almost think could be of more interest than this inverted head and shoulders pattern is to look at the actual Fibonacci numbers. Now, I have this on a separate screen because it gets a little bit busy, especially with all the colors on it. But I'm going to highlight here. This is the 61.8 retracement line. And that's a good sign for the markets. If the markets come bouncing back above that line, which is basically where the inverted head and shoulders pattern was, from here on up, that's also a good sign saying the path of least resistance is to go back and make that 100% retracement. Now, there's no guarantee of it whatsoever, but that is basically 2 good signs as far as charting patterns are concerned. And if we look at the NASDAQ, let me pull up the NASDAQ real quick, you'll see a very similar chart. This is the NASDAQ. This is actually a channel that I had drawn previously, but you also kind of see the head and shoulders pattern. And yes, today was basically a breakout on the inverted head and shoulders pattern. And then if you get even more crazy and you want to look at the Russell is actually leading the way. And we talked about the Russell a couple of weeks ago. Now, patterns in the Russell, it's kind of no holds bar. I don't necessarily think technical analysis is a big thing in the Russell just because it's such a volatile index. It's all over the place. But if we see this, we kind of have that same type of head and shoulders pattern. And we have definitely broken out to the upside. We're way above where our highs were just a few months back. So the Russell is actually leading the way, which is another sign, or another good sign overall for the markets. You'd like to see the small caps leading the way. That usually means that the economy is picking up a little bit. All right, so today's stock of the day, we're going to talk about the XLF. I'll pull up a chart here, Lindsay, and let me know what your thoughts are.
Yeah, but before I dig into the XLF, I just want to remind our viewers that there's a chat box in the YouTube app off to the right there. And Brian and I are going to take your questions at the end of the call about whatever is on your mind. I see a couple of you guys already chatting in there. We love that, so keep it coming. We'll try to answer as many questions as possible at the end, so feel free to type your questions there on the right. But let's go ahead and dig into the XLF. And I think you gave me the perfect lead in, Brian, because what you just said about the Russell 2000 starting to pick up the pace. Last week, by the way, the Russell 2000 was the best performing major index. It was up 6.4%. Remember, I said the S&P 500 was up 3.9% last week. So definitely an outperformance there. And what you said was that the pickup was related to optimism about a pickup in economic activity or reopening activity, which also could be related to stimulus. But that's the same type of analysis that we would use to look at the XLF, which is the financial sector. They do well when the consumer and businesses are doing well. And what we've seen here is very similarly over on the right-hand side of this chart here, you see a move higher in the XLF. So it's moved up about 9% since it's September 23rd low, which is just the recent low. It's still, as you can see from this chart, I'm glad you showed, since I don't know if this is the beginning of the year, it's still about 19% off of its high pre-COVID. So this has been a really unloved sector throughout the bull run since that March 23rd low. Um, and it's still down on a year-to-date basis. So it begs the question, is there more opportunity within this sector? If you do expect that the economic environment is improving, the consumer might be doing better than anticipated, and corporations are able to hang in there. Now, the knock against the financial sector and why it's had a hard time taking part and participating in this rally really has been low interest rates. You know, the Fed took interest rates down to zero early in the fall off of the market, and you know they have touted loud and clear that they have no expectations of raising interest rates at least before 2023. That doesn't bode too well, especially for the bigger banks who do a lot of lending. But what we're seeing is a little bit of a pickup more recently in the sector. And so Brian and I wanted to take a deep dive into it with you guys here today and see if we could come up with a paper trade for you all. Again, this is an unloved sector. The positioning amongst hedge funds is pretty weak. It's skewed. Most hedge funds are skewed to the short side here. But interestingly, last week, JP Morgan, their analysts, they made the call that now could be the time to look at the banking sector and take some cash out of healthcare, which has done extremely well, and put it into the sector that has been lagging. It's the second worst performing sector in the S&P 500, the financials, that is. Energy's the only sector that's worse. So financials down 18% year to date, but energy down 48%. So, you know, I always love to find value in the market. So I got me curious too. So I started looking at it. We're going into, like I said, we're going into earnings season for the banks here. JP Morgan kicks off tomorrow morning. We got Citigroup tomorrow. On Wednesday, Bank of America, Goldman Sachs, Wells Fargo, PNC, US Bancorp. We start getting to see some of the regional banks. Thursday, Morgan Stanley, Schwab. Friday, we get the likes of BNY Mellon, Citizens, State Street too. So we got a lot of the sector reporting this week and into next week. And the sector does have some positive things going for it going into the reporting period. Top line expectations, first and foremost, are actually really realistic. I talked about interest rates being low. Net interest income is a key driver of revenue for these guys. And that number has come down significantly over the past couple quarters as we've made our way through the pandemic. But if you look at the numbers, that's expected to reach a trough in either this quarter or next quarter. And analysts are expecting that net interest income is going to remain stable into 2021. So the good news is things are no longer falling off a cliff. So we're starting to stabilize, and the market starts to read that as a positive sign. The second thing I would talk about with the banks is the reserve requirements bill. Over the last couple quarters, we've seen these banks take a lot of money and put it on the side in case the economic environment gets a lot worse. They need that money. They need that capital to make sure that their business is able to run. And so the US government doesn't have to bail them out again like they did back in the financial crisis. So they put a lot of money off to the sidelines. It looks like they're no longer going to be, or they're slowing the amount of money that they're going to have to put on the sideline this quarter. The expectation is little to no extra cash is going to be put into what they call reserve requirements. And so that's like removing this massive overhang from the group, and because it means things are in the economic environment stabilizing to potentially getting better. Now, what'll be a better sign when they start to draw down those reserves and start to being able to use that capital again. We're not yet at that point. The expectation is pretty conservative. The banks aren't going to use that again until the second half of next year. So expectations are pretty conservative. If you look at some of the banks with capital markets exposure, IPOs, debt issuances have continued to be on fire. So that'll benefit those guys. There's opportunity to continue to cut costs, using better technology, reducing costs there. Valuation. When I look at the XLF from a valuation perspective too, on a PE basis, it's trading slightly above its historical average at 14.3 times. This 10-year average is about 13 times, way below where the S&P 500 is trading right now at about 25 times. But a lot of times investors look at these things on a price to book value to see what they're worth. And a price to book value of 1 means that the stock is trading in line with what the balance sheet is worth. Right now, they're trading a little bit of discount. So they're trading at a price to book value of 1.2 times, which is below their historic average of 1.3 times. So that is also has us curious. Now, a lot of the big banks suspended dividends and stock repurchases in the second quarter, I think it was, at the request of the Fed to preserve capital requirements again. And that expires in this quarter or next quarter. And the expectation is these banks could start raising their dividends again, and maybe potentially start buying back shares again. If there's value in these, you think the companies would want to buy their own shares, right? But that won't happen until next year. That's at least the expectation by analysts, which again, I think is kind of conservative. So there's all that. Things aren't perfect for the banks. Low, like I said from the very beginning, low interest rates don't really work too well for these guys. And the quality of the loans that they have is still uncertain. We've been able to see some of the mortgage loans or the car loans that have been put into forbearance. The expectation is that people are getting back in and starting to pay those again. But the question is, we don't know exactly how that's going to pan out, depending on how the job market plays, stimulus, all that stuff. So we're not out of the woods yet with the banks. We think this could be potentially an interesting opportunity here. So Brian's been looking at a couple different trades from an options perspective. But as you know, try to cover both the positives and the risks when it comes to these things. I hope I was able to help you think about it from both perspectives here. But again, Brian, I'm going to pass it over to you to talk about the trade that you've been looking at. But before I do that, remember, questions on the right-hand side in the chat box. We're going to take them at the end. All right, Brian, it's all yours.
All right. Thank you so much, Lindsay, for that great fundamental analysis. So with that being said, we're going to look at a little bit more longer term trade. Now, this is going to be a paper trade. It's not meant to be a recommendation. I'm going to pull up the options playbook here. Here's the Ally Invest options playbook. We're looking at buying Leaps as a stock substitute. And the reason why we're going to look at the longer term option contracts, the XLF is a fairly inexpensive ETF. It's trading around $25 or so. So it is possible to buy 100 shares. And because of that, we're going to look at 2 paper trades here. We're going to start by looking at the long-term, the Leaps option. And Leaps just stands for equity and long-term equity anticipation security. It's just an acronym that means we're going to go out longer in time. And technically, this isn't actually a LEAP option. We're going to go out into the new year, but normally a LEAPS option would be over a year in time where it comes from. But the concept is still there. So we're going to go out over 90 days. We're going to go deeper in the money. We're going to look at buying about an 80 delta option contract, which we talk about here inside the options playbook, which means you get a lot of stock price representation. When you have an 80 delta, that means if the stock goes up 1, you would expect your option contract to go up approximately 80 cents. Now, it's a theoretical number, but it just kind of gives you a realistic expectation as to how much your option can move relative to a change in the stock price. And then at the very end, I'll kind of just look at, well, what if you did buy the stock? What's something we could do with options to offset the cost of the stock initially? And that's mainly because I'm going to pop right back to this chart. And you just see we have, out of the last 10 days, we got a lot of green candles here And this area right here might be a little bit of a resistance right around the 26 level. So maybe we sell a short-term call against our 100 shares of stock, and that would be considered a covered call position. So let's run to the Ally Invest option chains. And we see right now we're up about 0.5% in the XLF, and it's at 25.40. It's up 17 cents on the day. This is the near-term option that's 4 days out. But if we're going to do the leaps, if I click my little chains here, there are many different expirations that are available. We're going to just go out to January. And quite simply, if you're going to be trading options, you're going to go longer term. I'd rather be able to sell it in the new year and have some tax advantages, quote unquote, of being able to trade this out until 2021. Talk to your tax advisor. We don't talk about tax advantages here on the stock play of the day, but overall, that's the concept. You could even go a little bit longer out in time. But one of the reasons why I don't mind doing a leaps option on the XLF is that the markets are very liquid relative to a lot of the other stocks. As a matter of fact, if the markets were tighter in long-term options going out 1, 2, maybe even as much as 2.5 years in time, that's what we have on the listed exchanges. If those markets were a little bit more liquid, I'd be hard pressed to say, well, if you have a 1-year outlook, why would you even buy the stock? Why wouldn't you just rent it? And that's kind of what a long-term call option can do for you. So let's go and look at that option contract that we're considering. And I'm going to focus here on the left-hand side of the chains, because we see that's the call options. The right are the puts. Here's the underlying stock price. Now we have a column called Delta. Delta on the 22 strike, that's $3.41 in the money, based off of where the underlying stock is at, has a delta of 83. That means that this represents about 83. If the stock goes up 1, this option contract should go up about 83 cents, or you could say it acts like 83 shares of stock. There are many different ways that you can define delta overall, but you just have to get a handle on how it can help you when you're picking the option that you want to own. Now, with this said, this is a longer term outlook. We want a surrogate for owning the stock. We're not going to sell anything above it because we're managing our risk overall by just buying this option contract. So if I look at this, I have a 10-cent wide spread, and that's what I was talking about a little bit. If I go up to the 23 strike, I have a 7-cent wide spread. Now, that's not too shabby relative to in the options world, but obviously the stock has just penny wide spreads, right? You're looking at between the bid and ask, maybe 1 cent or 2 cent at any time as far as the width of the spread is concerned. So that is always an issue by buying longer term options. But like I'm showing you right now, it's not quite as bad in the XLF. That's why we're considering this as the paper trade for this week. So I'll make that official. I'm going to check this little box over on the left-hand side. That means it puts it down in our workbench. And we're seeing here that we'll probably work this order a little bit when you're getting into it. So the liquidity concerns on the entry point aren't quite as worrisome, right? As if you were worried about the market going down and going against you and you're in a hurry to get out. But in this instance, we could work it a little bit. We try to get it executed at the midpoint. We see the bid is 375. That's if you were selling. The natural right now, if you're buying, is the ask price, which is 385. I'm going to put this in the right rail by clicking the trade button over here. And this is actually the Ally Invest order ticket. And we see that we are buying to open one of the January 15, 2021 strike call options. We'll do a midpoint of $3.80. That'll be a day order. We're going to try to work this order, try to get filled at that midpoint. That means our total risk is $3.80. So think about this. I'm getting something that acts like 80 shares of stock or acts very similar to the stock price. It's still an option though, and it still has an expiration date, but I'm getting a lot of that stock price movement. But I've already limited my risk to $3.80. Now, I could buy 100 shares and say if it goes down $3.80 and get out, that's possible. Then I'd have to set an alert. I could get out. But now I'm totally managing my risk. If I was thinking about buying 100 shares, I buy one contract. I know I cannot lose more than $3.80 on this trade overall. And I think that's the way that you need to approach this leap option. Now, If you're buying this as an alternative to owning the stock, just buy the same number of contracts that you would be buying in round lots of 100. If I was going to buy 100 shares, buy one contract, buy 200 shares, buy two contracts. That simple. And then you're managing your risk, realizing that, yes, I could lose everything that I invested on this trade. But if I do lose that, it's going to be $3.80 as opposed to having all the risk of owning 100 shares of stock outright. So that is the first paper trade for this week. Not meant to be a recommendation. We're just trying to learn here. But this is a time where you could consider it. And it's mainly because the markets are fairly liquid in this underlying, and that allows us to go out further in time and get a decent market on a longer term in the money option contract. All right. Now, I mentioned that we talk a little bit about a covered call. And that means you own 100 shares of stock. Now, a lot of people that do covered calls own the stock. They've had it for a while. I don't mind selling it. I will sell a call against it, saying you can call my shares away from me at a specific price. Today, the way that I would approach this is if you're a little hesitant, well, it's made a big run up just over the last 10 to 15 days. We've had a pretty solid run up in the XLF. So I'd like to get in, but gosh, is it going to back off a little bit? What are my concerns? Well, if that's your concern, getting into it using a covered call position isn't a bad way to go. So we're going to look at a shorter term option contract. Not the 4-day. We'll go out to 11 days because I don't want to be in this position too long in time. It's all up to you as to what actual strike price that you would like to do. So today we see that the underlying stock is up 19 cents. We're at 25.42. If we go out and look at the 11-day 26 strike call option, buy 100 shares, sell that against it, bring in that amount that it's actually ran up today. It gives you that obligation to sell that underlying stock at 26. Now realize I have 100 shares. We're saying we bought the 100 shares already. And I have that obligation, but I'm going to bring in 21 cents for just saying I'm willing to sell my stock about it's at 25.40. So 60 cents higher than where it's currently trading. So sometimes if you're a little nervous getting in because you've seen a stock run up, one thing that you can do is just sell a short-term call and give yourself a small pillow to land on over the next 11 days, bring in just a little bit of capital on your 100 shares of stock to try to make sure that you got the right price. Now, what's the downside? In this instance, I think it's a little bit more on the opportunity. If the stock did skyrocket and jump up 2 or 3 points, you're obligated to sell your stock at 26. So I get cash now, but I take on an obligation later. But that obligation only lasts for 11 days on the covered call position. So once again, it's all about learning here on the stock play of the day. This is meant to be a paper trade. You need to learn about options before you try to dive in on them. But as far as this underlying is concerned, there are 2 different ways that you can approach getting into a position on the XLF. All right, Lindsay, I'm sure that generated a lot of questions. What do we have here as far as the chat box is concerned?
We got a lot of chat questions and not a lot of time. So I'm going to try to pick a couple of these. Patrick Parker asked, Brian, would you do a bull put spread on XLF now?
Well, if you wanted to buy the underlying shares, you could look at it. So we're talking about more of a longer term outlook on the XLF. We've done a couple of speculative trades the last couple of weeks on the stock play of the day. Today, we're looking at a little bit more longer term view. So if I was selling that cash secured put, I'd be doing it because I want to buy that underlying stock on a pullback. So that would be one way that I would approach it. But that if you're doing just a short put spread for speculation, that's okay. That means you're neutral to bullish on the underlying stock. But we're looking at a little bit more of a long-term position here in the XLF.
Sure. Okay. So Jennifer says hi. Hi, Jennifer.
Jennifer.
We got a couple other questions. Lin Ji Zhu says, to sell a call with stock, what level should I set my account up for? I think he's asking what numeric level.
All right. Well, that's a simple one. That's the lowest level possible. If you're selling covered calls on a position that you already have, that means that you can have level 0. And level 0 means that is the most basic trade overall. as a matter of fact, and every firm has it a little bit different how they pick their levels. Some people start at level 1 as opposed to level 0. But in this instance, if you own 100 shares of stock, the simplest trade to do is sell a call against it, saying you'll sell your stock if it goes higher in the short term.
Yeah, and you don't require a margin for that, correct?
No, unless you don't require margin as long as you have the underlying stock. So that does mean that you could do it in a retirement account. You can through Ally Invest. Not every brokerage firm allows it, but at Ally Invest we do, and quite a few other ones do too. So if you want to sell a call and you own that underlying stock, there's no more additional margin.
All right, I'm going to squeeze one more in really quickly here for Scott. The XLF is up against resistance. Would selling a put be better right now?
Well, that was basically the same question as selling that short put spread. Selling a put would be very similar to that trade, and I think we kind of covered that a little bit.
Right, exactly. Sorry, my fault. Well, I think we got a lot of really great questions. Maybe one last one. What technical trends should you look for to try to determine if it's time to close out an option?
A technical trend?
Yeah.
Well, in this instance, we're a little bit more longer term bullish. Obviously, support and resistance are always. I'm not a master technician. I'm not a CMT chartered market technician overall. But sometimes when I'm looking at things, it's just simple support and resistance. So I'm going to pull up a screen here. Like right here, that's fairly straightforward. If you're trying to do a shorter term play on it, that it might have a little bit of problems if you see my crosshairs breaking through that new recent high at around 26.85. I think I look a little bit more at support and resistance as trying to pick sell points. If I can break through that level, that's a good thing to the upside. But overall, I don't really delve into that, and that's not what the stock play of the day is. Overall, we always try to address it, but we don't want to get too technical, pardon the pun, on the technical analysis.
Yeah, we're not technicians, but we like to use technical analysis as another tool in our box of tools when we're looking at stocks and options. So we know a little bit, but we're no experts. Now, that's all we got the time for today, guys. Thank you for all of your questions. You've been really chatty and great today. Be sure to tune in on Friday, the same channel, right at noon. Brian's going to take a review of this exact trade to see if there's any adjustments that could be made and see how it's performing so far. So tune in on Friday at the Ally YouTube channel. Stock Play of the Day Overtime is the name of the show. But that's going to do it for today, right, Brian?
Yeah, definitely. And don't forget to click subscribe and ring the bell, and then you'll get all the alerts for all the stock plays of the day. Thanks for coming, and we'll see you this Friday.